Okay, let's talk about Target. We all know that feeling, right? You walk in for one thing and you walk out with a cart full of stuff you never knew you needed. But, if you were a Target investor over the last few years, that feeling has been, well, a lot less fun. In fact, it's been downright painful. And today, we're going to investigate why.
Just look at this chart. It really lays the whole mystery bare. On one side, you've got the S&P 500, the broad market, just soaring, up nearly 77%. And on the other side, you've got Target, which, in the exact same period, cratered over 40%. I mean, that is a staggering performance gap of more than 117 points. If you owned the market, you were thrilled. If you owned Target, you got crushed.
So this brings us right to the core question, the big mystery we need to solve. What in the world is going on here? Did the market just get it wrong and unfairly punish a great American company, maybe creating a huge buying opportunity? Or are there some really serious fundamental cracks in the business that totally justify this massive sell-off?
So we're going to treat this like a real investigation, like we're opening up a case file. You've got two completely different stories. On one hand, you've got the argument that Target is a fantastic bargain, a deep value stock with this juicy 4% dividend. But on the other hand, you've got the story that the business is actually broken, that it's a classic value trap waiting to spring. Let's dig into the evidence for both sides. And we're going to start with Exhibit A, the red flags. This is the case against Target. These are all the reasons investors have been running for the exits.
So red flag number one is all about the top line, sales. During the pandemic, Target's revenue just exploded. I mean, an incredible $30 billion jump. But that was the total sugar high. As you can see from this chart, that growth is completely, and I mean completely, stalled out. In fact, analysts are projecting that 2025 revenue will actually be lower than it was in 2023. So right off the bat, you have to realize, the growth story here is over.
But the problems were so much deeper than just slowing sales. Take a look at what happened to their profitability in 2023. Their operating margins, which is a really key way to measure how efficient a business is, just fell off a cliff. They crashed from a really healthy 8.4% all the way down to just 3.5%. This wasn't a little dip, folks. This was a 5-alarm fire inside the company, all because they had way too much of the wrong inventory and costs were spiraling.
And as if that wasn't bad enough, while all of this was happening, the company's balance sheet was getting weaker. Their total debt grew by nearly $6 billion in just 5 years. So this is the trifecta that the bears, the critics of Target, point to. You've got stalling revenue, you've got crashing profits, and you've got rising debt. That is a really dangerous combination.
So let's just recap the case against them real quick. Stagnant revenue, crashing profits, rising debt. I mean, looking at this evidence alone, the situation looks pretty bleak, right? It looks like an open and shut case. But, as with any good investigation, that is not the whole story.
And then, just like that, the story takes a turn. By the time we get to 2025, a completely different picture starts to emerge. Yeah, revenue growth is still stalled, but look at those green check marks next to profitability and cash. The source material we're looking at sums it up perfectly. The bleeding has stopped. The patient is stable. This is the turning point in the story. So the big question is, how did they pull it off?
And that brings us to Exhibit B, the recovery. Now we're going to flip the case file over and look at the other side of the coin, the evidence that a powerful turnaround is already happening.
Okay, remember that terrifying margin crash we just saw? That nosedive? Well, look at the right side of that same chart. Management didn't just sit there. They took decisive action. They fixed their inventory mess, they got their operations in order, and the results were dramatic. What you're looking at here is a classic V-shaped recovery, with margins climbing all the way from that 3.5% crisis point back up to a much healthier 5%.
But this is the real smoking gun for the bulls, free cash flow. This is the actual cold, hard cash a business has left over. In 2023, during that crisis, Target burned through $1.5 billion. It was a terrifying number that had investors spooked. But now, look at 2025. The business has become a cash cow. It's projected to generate nearly $4.5 billion. That's not just a recovery. That's a massive swing from burning cash to absolutely printing cash.
And all of that cash has a huge direct benefit for shareholders. It means the dividend is safe. That really attractive 4% yield isn't a trap. See, the company's dividend only costs about $2 billion, which is easily covered by its nearly $4.5 billion in free cash flow.
This is really the heart of the bull case. Investors get paid a nice income just to wait for the stock price to catch up to reality. So how did they do it? It wasn't magic. It was old-fashioned discipline. Management made a really critical strategic shift. As this chart shows, they slashed their capital expenditures, that's money spent on big projects like new stores and remodels, by nearly half from their peak. They basically pivoted from a strategy of grow at all costs to one of let's be smart, efficient, and preserve our cash.
But of course, this new, leaner, more efficient approach isn't a free lunch. It doesn't come with its own set of risks. So now we have to look at the other side of this efficiency coin, because there is a definite trade-off that management has made here.
And to really understand this risk, we need to quickly define a term: working capital. The easiest way to think about it is like a financial cushion for a company's day-to-day operations. It's the money on hand to pay the bills. If it's a positive number, you've got a buffer. You're safe.
And here's the catch. As you can see here, Target actually operates with negative working capital. Now, in simple terms, this means they are so incredibly efficient that they collect cash from you, the customer, at the checkout line before they even have to pay the suppliers for the goods on the shelf. It's a brilliant way to manage cash, but it's a high-wire act. It leaves them with absolutely zero financial buffer. If sales were to suddenly drop for some reason, they could find themselves in a cash crunch very, very quickly. This is the core risk that makes the stock so volatile.
Okay, we've seen the red flags, we've seen the powerful evidence for a recovery, and we've seen the risk that's still lurking under the surface. So let's bring it all together for the final verdict. What is the real story of Target stock today?
Here it is, the whole case side by side. The bulls, the optimists, they see a company trading at a deep value, throwing off a massive and secure income stream from that dividend, and they see an operational recovery that's already in the rearview mirror. The bears, on the other hand, they're focused on the fact that there's no top-line growth, the risks that come with that negative working capital model, and the fact that the company is really sensitive to a consumer recession.
So the bottom line is this. The source material we analyzed concludes that Target today is a classic turnaround play. You are not buying this stock hoping for explosive tech-like growth. That ship has sailed. You're buying it for two very specific reasons: that strong, steady dividend income and the potential for the stock's valuation to reset higher as the rest of the market finally recognizes that the business is stable, not broken.
And so that leaves the final verdict up to you. You've seen all the evidence now, on both sides of the case. You've seen the stalled growth and the balance sheet risks, and you've seen the stabilized operations and the massive cash flow. So the question for you is, do you look at this and see a classic value opportunity that's too good to pass up, or are the risks of owning a no-growth retailer in today's economy just too high for you?